All right, hello, I am Jason Bates, owner of Electrum Financial, where a mortgage is not just a flip of a coin. And if you're looking to purchase or refinance, I'd love to be your lender of choice. Don't forget to subscribe to the channel, tell your friends and family. I would love to help them as well. So we have this thing called QM, qualified mortgage, or non-QM, non-qualified mortgage. What does that mean? Well, qualified mortgage means that you can securitize that loan and sell it on the secondary market. That's a qualified mortgage. Now, there are certain standards in which the loan has to abide by in order to meet that qualified mortgage standard. Now, one of those standards is the debt-to-income ratio. The debt-to-income ratio, that standard, which is 43%, that is the qualified mortgage standard. However, there are quite a few loans that do not meet that standard. In fact, a lot of loans that I look at don't meet that standard. They're above 43%. So CFPB last year came out with a patch, what they call a patch, to make those borrowers who have DTIs above 43% still a qualified mortgage or fall into that qualified mortgage bucket. And that patch is due to expire this January. So in the infinite wisdom of the CFPB, they are trying to come up with some solutions. I say they're trying to, and we'll see what happens. We'll see. I don't want to, downplay them, but these are the crazy things that come across my desk that, I thought I'd run by you or give you some insight on. So let's jump into this and we'll take a look at this whole situation and what I'm seeing here. So let's zoom in on this, shall we? So that you can see what I see on this. So you can see this CFPB website, and as noted above, the GSE patch is scheduled to expire soon, and absent regulatory action, the Bureau estimates that approximately 957,000 mortgage loans would be affected by the expiration of the GSE patch. That means that 957,000 loans are made that are above that 43% debt-to-income ratio. Remember, Fannie Mae, Freddie Mac will allow up to a 50% debt ratio. So that's 7%, 957,000. I would suspect probably higher than that, but we'll go with 957,000. Many of these loans would either not be made or would be made at a higher price. So what does that mean? Well, if the patch expires in January, these individuals whose debt ratio is higher, they may get a higher interest rate because the qualified mortgage sees that as a higher risk. So when you got a high debt-to-income ratio, higher risk, therefore you may have a higher rate or loan level pricing adjustment to compensate for that risk. So I want to scroll down here a little bit because it really gets strange as to their solution to this patch expiring in January. And that's what I want to illustrate here right now. So let's zoom in here and I'll highlight here for you what the Bureau is suggesting here. This is crazy, people. This is absolutely insane. The Bureau is proposing a price-based approach because it preliminarily concludes that a loan's price is measured by comparing a loan's annual percentage rate to the average prime offer rate for a comparable transaction. Yeah. What is that? What is that? What are you talking about? We're talking about DTI, right? Debt-to-income ratio? Okay, let's continue on. A strong indicator is a strong indicator and more holistic. Holistic? What? Are you serious right now? Holy moly. Holistic and flexible measure of a consumer's ability to repay than DTI alone. Oh, man. Holistic. I didn't know we were rubbing crystals together to make a mortgage today, but apparently we are. Now, in fairness, I think the CFPB, what they're trying to do is make it a little more competitive, I guess is the right word, for all. So lower individuals who may have a higher debt-to-income ratio, they want to make it a little more level playing field. Now, this could hurt the mortgage bankers because the mortgage bankers, their price point, if their APR is higher than the average, APR because they're charging a lot of fees, or maybe their price point, their profit margin is such that they have to have a certain, margin put in place to be profitable. That may push their APR higher. Therefore, that loan may not be a qualified mortgage. So it may kind of maybe force those lenders who charge more or have higher interest rates to come down more on their interest rate and kind of trim the fat, so to speak. I think that's the intent here, but that is certainly not what they are saying here. So these are just some of the crazy things that come across my desk. I thought you should be aware. I always like to give my 2 cents. So that is this week's